The chip we bought from Nvidia last year, the sales of this chip, 46% was us. We bought 46% of all Orin X chips. It's quite a lot of money. Then what's the next step to reduce costs? Releasing our own chip equal to 4 Orin X. Meanwhile, costs will be massively reduced. Use R&D to trade for margins.
We actually now finally know NIO's path to profitability, thanks to what NIO CEO said back in April from that clip you just watched, and also from the earnings report. NIO laid out clear guidelines about how they're going to be profitable and break even. So first of all, during the earnings report, this is what he said. He said, regarding the NIO brands, starting from next year, we will gradually upgrade our product to the 3rd generation, and the first product on NT3 will be the ET9. And for the 3rd generation product, we will also take different approaches to improve the vehicle margin. For example, we will start to put more in-house technologies into our vehicles, like chips, for better vehicle margin performance. In other words, he's saying too much money goes to Nvidia, as Nvidia stock is making all-time highs with record profits. NIO bought 46% of all Orin X chips from Nvidia because each NIO vehicle sold has 4 Orin X chips inside, which is expensive AF. Most other automakers only put 1 Orin X chip, or they don't even put any Orin X chips at all. All right, at most 2, but NIO's putting 4 in every single NIO sold. So that just means that they're spending a lot just to build these chips, just to build these cars with these chips inside. They're paying too much for these chips, okay? And their own chips will be much cheaper, 4 times the capability. So 1 chip is equivalent to 4 Orin X chips, and it's going to really, really make it much more affordable. But also on the flip side, you got to think, how come NIO didn't come out with a NT 2.0 car that has only 1 Orin X chip, right? So this is something else to think about, okay? Maybe it was a strategy problem from the get-go. So let's just continue. We'll come back to this. We also see some opportunities with the battery cost reductions. So overall speaking, our target for the NT3 product margin will be around 20% on average. And we do have confidence of realizing that average margin of 20% from NT3. In other words, he's saying it's kind of hard with the NT 2.0 platform, which is the cars currently being sold because they're spending so much on these chips. And regarding the break-even target for the NIO brand, our target is still the same. That is to realize the monthly source volume of 30,000 units with a vehicle margin of around 20%. And then we will be breaking even with the core business of the NIO brand in China. And regarding our second brand, Onvo, we have announced the pre-sale price during the product launch. During the brand launch, but we haven't released the final price yet. Even with the pre-sale price, we can realize a pretty good vehicle margin. Of course, we also understand that the competition in the Onvo segment is more intense than NIO. In that case, we will also strike a balance between the volume and the margin. We will not boost the sales volume at a cost of our vehicle margin. And for the longer term, our targets with Onvo products, our margin target for products will also be above or even at around 15%. Because looking at Tesla, their current product margin is around 16 to 17%. And for Onvo, realizing a margin of above 15% is also reasonable and a target for us in the long term. For Onvo brand to break even, its monthly sales volume should be at least 20,000 to 30,000 units per month. So in other words, Onvo needs 20,000 to 30,000 units per month, which I believe is easily achievable, all right, with that product that they're offering, easily achievable. The problem is, of course, with NIO's current vehicles, NT 2.0 cars, they are nowhere near 20% margins, which is, of course, caused by those chips, right? 4 Orin X chips. Why couldn't they come out with a non-LiDAR variant with 1 Orin X chip? So with all this in mind, all right, the Onvo target to break even, NIO's target for break even with 20% margin, 30,000 deliveries, and Onvo at least 20,000 to 30,000 deliveries. That means you need a total delivery of NIO Group at around 60,000 deliveries per month to break even. Okay, so on the NIO brand, we're actually fairly close. We're at 25,000, but we're at 20,000, almost 25,000 in terms of orders. We got 30,000 orders, so we could possibly get around 30,000 orders very soon, 30,000 deliveries very soon in the coming months. Even though we're bottlenecked by delivery, hopefully they find a way around that. But 20% margin, that means we still have to wait until NT3 products get launched until we can realize 20% margins. Okay, so that means that profitability is pushed to at least next year. Okay, next year when the NT3 product gets launched. And even though when the ET9 starts deliveries, right, there's still going to be NT2 products being sold. Okay, and until everything shifted to NT3 and margins are very good and everything's using NIO's own NX chip, NX God chip, that's when we can start seeing more margin on every vehicle sold. So we'll have to see what they launch for NIO Day. All right, hopefully they launch more than one car. All right, and then they got these two cars, hopefully deliveries very soon in 2025. And then from then onwards, they're using their own chips, they're using their own in-house developed stuff, brakes, etc. And that's going to really help with their margin. Combine that with a higher average selling price, and Onvo doing extremely well, 20 to 30,000 deliveries per month. Then we could be looking at profitability in 2025 with all those conditions met. Okay, but going back to this whole entire debate, why 4ONX chip? It's so expensive to put in the cars, right? It's expensive AF, and it's really hurting margins. Why did they have to do it? Well, when the ET7 just launched, right? And remember, for NT 1.0 vehicles, they had pretty good margins. ET7 launched, and that had 4ONX chip. It was just revolutionary in terms of computing power, etc. And remember, ET7 was launched in late 2020. Okay, so 4 years ago, almost 4 years ago. And that had just tremendous capability, and it was touted to be the Model S killer. Okay, and of course back then this was pretty revolutionary, and the selling price of the vehicle was justifiable because it was the vehicles were still quite expensive. But then in June of last year, NIO did a price cut of 30,000 RMB, okay, for every vehicle, and they removed free battery swap, but that of course hurts their overall margin of the vehicle because it's so expensive to produce. You're selling it for less. That hurts their overall margins. So it doesn't seem that we're going to be profitable in 2024. We're going to be profitable once the product is shifted to NT 3.0 products, and then when they start using their own chips, their own stuff, and stop having to buy 46% of all ONX chips. I mean, Nvidia is earning a killing, and a lot of that money comes from NIO as well. So that's not good. All right. But thank God they have it all planned out. The chip is ready. They just need to shift the products to use these chips. So that's the very important next step. As always, stay safe, stay healthy. Peace out.